Deductions, it is crucial to understand the deductions because that is what helps you to bring down your tax liability, as you can charge these deductions against your income. So it brings down your overall tax liability. Common for individuals is like mortgage interest. So homeowners, the interest that they're paying on their home loans, they can deduct that interest from their income. Student loan interest, individuals repaying education loans can deduct the interest paid. Then charitable contributions to qualified organizations. A taxpayer donates $1,000 to a charity. They may deduct that amount from the taxable income, lowering the tax obligation. Ultimately, it helps taxpayers keep more of their money by reducing the amount subjected to tax. And that is why it is essential for effective tax planning. Now, tax credits. They reduce the amount of tax owed rather than taxable income. So there are dollar for dollar reduction, like we discussed. One example can be education expenses can qualify for credits such as the American Opportunity Tax Credit. So it provides credits for qualified education expenses, easing the financial burden on students and families. Credits for energy efficient home improvements, installing solar panels, also spending money on solar panels. That also is available as a credit. So your taxpayers are incentivized to invest in sustainable practices. Credits differ from deductions. Deductions reduce taxable income. Credits reduce the tax bill directly. So provides immediate financial relief. Now tax rates. Let's look at the slab rates for individuals. So these are the 2024 federal tax brackets. So you can see tax bracket slash rate. It is different for single. It is different for married filing jointly. It is different for head of household. We will cover it in more detail in our module regarding individuals taxation, but in a brief manner, single is individuals unmarried or legally separated. They are usually taxed slightly higher, and but it provides the benefit of standard deduction. Married filing jointly. This is when married couples combine their income and deductions. It usually results in lower tax rates and a higher standard deduction. It also provides access to various tax credits. So filing jointly would provide more tax credits. Head of household. This is when you are an unmarried individual and you're providing a home for a qualifying dependent. This also is slightly lower tax rates than compared to single, making it beneficial for single parents or caregivers. So if you look at the slabs, for single, the tax rate, the slab begins earlier. So like at 47K itself, you're paying 22% tax. But for married filed jointly, up till 94K, you can pay just 12% tax. So there's like huge benefit for depending on if you're single or you're married filing jointly in terms of these slab rates. Now that we've looked at components of tax rates, let's look at the major federal, state, and local bodies that affect or create the legislation for these tax, uh, the tax structure itself. So federal tax governing bodies. So federal, we're talking about. So in the US, they have a federal and a state system. Federal government is like the central government. They accumulate revenue through living tax on the individuals throughout the country. And throughout the country, the money that the federal government receives, They use it to spend on their own programs. So one tax as existing in US, one tax you will be paying is to the federal government. There are also state taxes. That is for while you're operating your business in a particular state, you also pay certain tax rates to that state. That state tax rate is levied by the state government, and it can vary from state to state. Federal is consistent amongst the entirety of the US. State tax rates can differ among different states. So they have a federal plus state system in the US. So that governing bodies for federal tax are Internal Revenue Service, IRS. This is the primary agency responsible for administering and enforcing federal tax laws. So the entity that you file your taxes to, your federal taxes to, is the IRS. IRS collects your taxes annually, collects millions of your tax returns, handles any inquiries. It also conducts audits. So let's say you filed a tax return, maybe you filed it incorrectly. So IRS, they don't audit all the tax returns, but through auditing, um, they try to ensure compliance and address discrepancies in reported income. If you've not reported it correctly, then an IRS audit will show those discrepancies and will collect. You will have to answer the audit questions to reach what your final penalty or amount owed is after the audit. Department of Treasury. Department of Treasury oversees the IRS. It is IRS is specifically for enforcing tax laws, federal tax laws. Department of Treasury is more on a more global, not global, like more national economic and financial level, the policies that they're formulating and implementing. And one of the policies relates to taxation. It also plays a key role in shaping tax legislation and ensuring the government's financial stability. Next one is Congress. Congress enacts the tax laws. So every law, every maybe Tax Cuts and Jobs Act or other bills, they are first put uh, put for debates in the Congress. The Congress debates on them, votes on them, and ultimately, when the bill um, gets through the entire system of these debates and these votes, and after vote it is enacted, um, that is when the bill is final and it gets enacted throughout the country. So Congress is where these legislations, these discussions happen. You put forth a bill and you have to make sure it gets all the necessary votes for it to be enacted. One of the examples is the Tax Cuts and Jobs Act of 2017. Again, IRS, the primary agency, it administers and enforces federal tax laws, ensuring compliance from taxpayers, processes millions of returns, collects your taxes, handles any queries, provides assistance for tax-related questions. Very importantly, it is the body that conducts the audits to verify accuracy of reported income and deductions. You almost have seen it in movies how critical can an audit from IRS be. Then it manages tax collection in the US. It implements, so once a legislation is passed by the Congress, implementing those legislations, adapting to changes in tax policy, that is the function of the IRS. It also spends a lot of time and effort to educate the public about about tax and give them education regarding it and about their obligation. It also utilizes data analysis and technology to improve efficiency in tax administration. What is IRC? Internal Revenue Code. Right now, we just read about Internal Revenue Service. That is the body, governing body. Internal Revenue Code is the set of tax laws. So all the tax laws, let's say for financial reporting, you have US GAAP, generally accepted accounting principles. For um, to conduct audits, you have GAS, generally accepted audit standards. Similarly, for taxation, the tax laws are uh, put together in IRC, Internal Revenue Code. It is the comprehensive set of all the tax laws in the United States established by Congress, outlines rules for federal income, estate, gift, employment, and excise taxes. IRC is crucial for determining how taxes are addressed, collected, and enforced, making it a vital component of the US tax system. IRC helps taxpayers and professionals navigate tax obligations and optimize tax planning strategies. So, going through these laws is what helps you understand the structure, plan for the structure, and also navigate through this, like through your tax obligations. Let's just take another water break. Next is state tax governing body. So, we just looked at federal, the IRS, Department of Treasury, and Congress. In states, you have state revenue departments and state legislatures. The state revenue departments are responsible for assessing and collecting tax similar to IRS, including income, sales, and property taxes. They ensure compliance with state tax laws and often conduct audits similar to the IRS. They might audit a business to verify the accuracy of state tax, sales tax collected. State legislatures, these create laws regarding taxation. So similarly, you have for federal legislation, you have Congress. For state legislature, you have they also create laws regarding taxation, including tax rates and regulations specific to each state. So in US, states can have their own legislatures regarding, especially regarding tax. One state can charge you zero tax rate. One state can charge you up to 14% tax rate. That all completely depends upon what state it is. So examples. So California is one of the states with a high tax rate. It increased its top income tax rate from 13.3% to 14.3%. That money or the fund is used for, let's say, education and healthcare programs. New York has introduced a new digital advertising tax. This is for generating revenue from large tech companies operating within the state. Texas eliminated its franchise tax for small businesses with revenue under $1 million to encourage entrepreneurship and growth. So it just removed and eliminated all the franchise taxes for businesses under 1 million. Florida reduces state sales tax rate from 6% to 5.5% to boost consumer spending and stimulate the economy. Local tax governing bodies. So we've discussed state, now local. County tax authorities. So when you're like even in a state, you are operating in different counties. So one of the tax that the county tax authorities levy is property tax rates. This is to fund public services such as education and infrastructure. They also collect taxes necessary for local government operations and services like law enforcement. They also adjust the property tax rates based on changes in property values to ensure adequate funding for local schools. Municipalities. So local municipalities can also impose taxes on residents, which can include income taxes, can include sales tax. They collect fees for services such as waste collection and public utilities. Some cities have local income taxes that add to the overall tax burden on residents. So it's not just that you're being charged federally, you can also be charged by the state, by your county, and by your municipality. So county tax authorities, they assess property values, determine the amount of property tax owed. These are authorities to collect taxes to fund essential local services such as education, law enforcement, infrastructure maintenance. So think of county as more for infrastructure. So you have buildings to maintain, you have roads to maintain, and they also, the house that you've purchased, you pay property tax on that house. Municipality tax authorities are more for uh, your neighborhood services like waste collection. They collect tax to fund those purposes. Um, they can impose various taxes in income tax, sale tax, property tax. They can also impose property tax. They might even charge fees for services such as waste collection, public utilities. So navigating this system of US taxation, look, after all these, we've understood the different bodies. We've now understood what the different components are, what are the different bodies levying the tax, administrating and implementing tax laws. Through this system, we want to navigate so that all the tax obligations that an entity has, either regards to federal, state, or the local tax, you are understanding those obligations and you're compliant with those obligations, and you don't want to pay any penalties. So knowing these responsibilities is crucial. IRS has many resources. There are a lot of tax softwares available. There are a large group of professional tax advisors to simplify the filing process and clarify tax regulations. You should always, as a tax practitioner, and even as an individual, if you are living in the United States or a business entity, you should be informed and up to date with changes in tax laws and reforms that may impact your tax situation, as these can affect rates and available deductions. It is also important to identify potential deductions and credits that apply to your situation. For instance, mortgage interest deduction, educational tax credits. Challenges in the US taxation. One is complexity of the tax code. It is one of the most complex in the world, making it difficult for individuals and businesses to understand their obligations. Numerous deductions, credits, different tax rates complicate the process of filing taxes. Just looking at the slab rates for individuals, you saw how it was not just, it wasn't even a round figure for all the tax slabs. It was dollar amounts here and there can make you fall into a different slab. So it's super important to, so it gets complex understanding the tax system. And as it is a federal, state, and local tax structure, understanding all those, how they interact with each other, can also be confusing for the taxpayers. So this is that it is super complex. The challenges are such intricate rules could lead to errors in tax filings. It also increases the reliance on tax professionals. So as a tax preparer or a practitioner, it is useful because they have to avail your services. But for someone who wants to put in the effort to do this themselves, it is a super complex system that even if they put in the effort, they might make errors. So they have to rely on tax practitioners. And any changes in the tax laws or policies can create uncertainty, making it challenging for taxpayers to plan effectively for their tax obligations. So compliance comes with complying with these tax laws. Compliance relates to paying taxes on time, filing your tax return, if there is any extension to be filed, any quarterly payments to be filed, all of that comes under tax compliance. Tax planning is strategies to minimize tax liabilities. Techniques include maximizing deduction, including tax credits, and optimizing income reporting. So, one of the examples is, let's say in the current year, your tax rate is 20%. In the next year, your tax rate is 35%. So, tax rate is increased, and it is a flat tax rate. Let's say you're a corporate entity and the tax rate is increasing by 15%. In that case, if you have reductions that you can take next year rather than the current year, then you would want to do that. Because let's say gross income is consistent over the 2 years, you would want a lower taxable income next year rather than current year, because next year you have to pay 35% tax on it. This year you only have to pay 20% tax on it. So you would want as many reductions that you can defer for the next year. You would do that so that your ultimate tax liability is less. So such planning strategies, while looking at the future along with the current situation, other items like how you can use a deduction, how to get a deduction for a certain item, like for depreciation, rather than using a straight line method, you can also take bonus depreciation, which means in the current year itself you can deduct up to 100% of the entire value of the asset. So that is also a deduction that is available and reduces your tax rate, tax liability. And last is engaging with tax professionals. So this compliance and the planning, these are two key services that tax practitioners provide. They help you stay compliant. They help you file taxes, calculate estimated payments, paying estimated payments, filing extensions, and staying compliant altogether. Then is you consult the client for their tax planning strategies. You consult them in terms of how they can make certain decisions in their operations of the business, which leads to maybe more deductions or more credits. Understanding both of them is crucial for you to become an equipped, experienced, and competent tax practitioner. Grasping these concepts will provide a clearer view of one's obligations and rights. Being informed about tax obligations allows individuals and businesses to optimize their tax situations and avoid potential pitfalls. Yep. So that is it for today's session. We are just introducing you all to the system of taxation in the US. Next module, we will discuss different business entities, how the structure is for those entities, and how the tax rate is applied for them. Then in further modules, we will discuss each business entity in detail and even look at the different tax forms that they have to file with the IRS. Thank you all. I'll join you in the next session.